So I decided to do it. So I decided to do it on the call, where I'm sure that a lot of you would see, would hear, and as well, people that would go through the recording would listen to as well. The admins on the sample group are just like an extension of me, right? I'm currently writing my exams, which means that I may not have 24 hours presence in sample. But you're very sure that when I'm not replying, either of the three of them are replying, which means that they are just like extensions of me. If you don't see me, you see them definitely, right? I don't like the whole thing that was going on yesterday with exchanging words and all of that, and apologies, this and that, up and down. Like, I didn't want to address it, but then a lot of us are more mature than that. Trust me, I don't like working in environments where respect must be commanded. I don't really like creating. I don't want to create the whole idea that when you come to sample, it's all about like Salma. These are things, they are well behaved. I promise you, these are people that I work with on personal levels, minor sample now, right? So I can vouch for their character. But then misunderstandings happen where you may have misunderstood what they meant, or they misunderstand what you meant. And that is not a call for who is right or who is wrong. The main focus, or your main focus right now at sample, is to get what you need and get out. Honestly, right? To get the knowledge that you need, get the results that you need, and leave. That is the main focus. So whatever you have to do in between does not really matter. If someone should ask you to change your Zoom username to your Telegram username, it's a simple instruction. And if you're having issues doing that, you can reach out to any of the admins that, okay, I tried doing this and it was not possible, right? For every instruction that is given to you on that sample group, there are good reasons why. We notice that some people are sharing the link to the Zoom calls to other people. And that is why you were asked to use your Telegram username as your Zoom username as well, so that you won't get removed thinking that you are an imposter, right? So it's that simple. They're not doing it because they want to punish you or they want to stress you to do all of that. Please, I would really appreciate that you respect these people as much as you would respect me as well, right? They are seriously working. I won't lie to you. They're seriously working. They're seriously aiding, right? And as well, I'll try to tell them to be as calm as they can with you guys, but please, so that this environment will be very conducive for both teaching and for learning, right? So for today's class, we're going to be treating supply and demand zones. Remember that we did market structure, I think, for the last 3 sessions. And I told you that if you can understand market structure properly, you've solved at least 60% of your trading problems when it comes to technical analysis. Because market structure gives you what? Direction. But then it's not about knowing the direction now, right? It's not just about knowing the direction of what is going to happen in the market. The next problem becomes, how do you now join in that known direction? How do you make money with what you know? Like, the next problem is now, where should I enter from? You know where it's going to. Where should you enter from to be able to go with it to where it is going to? So these subsequent classes we'll be having from now, these are the things we're going to be treating. Now, a lot of you, I know for sure that a good number of people on this call, even if you've never, for those in Nigeria, at least you should have had one contact or another with the market, right? You've had to buy or to sell something before. Now, you would agree with me that if you go to the market with your mother or your father or your other siblings, or if you even go alone, for most people, when you go to the market and then somebody asks you, and then you ask the person selling maybe fish, you ask her, oh, madam, how much is your fish? And she says it's what, 3,000 naira. The first thing that comes to your mind is to do what? Is to price down. You know, go sell 1.5, right? This means that it is our natural instinct to do what? To buy at lower prices. You go to the market, how much is this barrel? 150. Ah, since when? Give me 100 naira now. Do you understand? You want to beat the price down. But imagine that you are the seller. You have what? You have a packet of pen to sell, right? You have a packet of pen to sell. And then somebody comes to your shop to come and buy. Now, initially, the price of that pen is 100 naira. But when somebody comes to your shop to come and buy, you want to tell them that what is 150 so that they can what? So that they can maybe price down to 120 or maybe that 100. You understand? Meaning that it is our natural instinct as humans and as traders to want to sell at higher prices. You want to sell things higher than you actually bought them. If I should give 5 people in this class now, maybe a phone, right? I give 5 people in this class an iPhone worth say maybe $500, right? And then they intend to sell it. You would believe me that they would want the price to get to like say $700 before they sell. Nobody will want to sell for $200 because they're the ones supplying now. They want to sell at higher prices. But then if you want to buy an iPhone and then they tell you that this iPhone 16 Pro Max is 3.5 million, the first thing that comes to your mind is okay, you know go sell for 3 million. Meaning that we're looking towards buy at lower prices and sell at higher prices. That is how it is in the market, right? As traders, we're always looking towards buy at cheaper rates and towards sell at more expensive rates or higher rates. Now, over to demand and supply. There are 2 types of demand and supply zones. If you guys remember the class we had on range, that's market structure, when I emphasized on the 3rd type of market structure, which is called the ranging market structure or the consolidation market structure. If you remember, I told you guys that market structure creates equal highs and equal lows, right? Now, we've not gotten to liquidity, but there's a line of equal highs and equal lows that says that there's liquidity resting above that. I don't want to explain that until we get to liquidity so that it doesn't get overwhelming. But as price is doing jumping from up and down, up and down, up and down, up and down, there is a time that it actually breaks out. This is a more practical scenario. If you guys remember the example that I gave, whereby we put people of similar heights in one room, they are jumping to the ceiling and falling back on the tiles on the ground. They are jumping again to the ceiling, falling backwards to the tiles on the ground. You would agree with me that there is a level of impact that they keep jumping with, that they keep on jumping with all their strength. There is a time that they might jump and probably hook a hole in the ceiling. Do you understand? Like somebody now makes an incision on the ceiling, right? They now break out from the ceiling. Or they might keep jumping depending on the kind of shoes they are wearing and make impact on the tiles that it cracks or it breaks. Do you understand? That is how the market is. It can have series of higher equal low, equal high, equal low, equal high, equal low, equal high, equal low, equal high. Facing a resistance here. And what happens? It breaks out of it. You understand? The moment whereby it breaks out of it. This breakout, if it's to the upside, it creates a demand level, which is what we call a range-created demand zone. Let me write that down. Which is what we call a range-created demand zone. Now, this range-created demand zone is a type of demand zone that is created by by a range, whereby price was consolidating or ranging, and what happens? Minutes later, it breaks. After a while, it breaks out of that range. The breakout out of that range is going to create what? It's going to create a demand level. And then we have the same thing for the supply zone. When you have price consolidating or range just like this, creating series of equal highs and equal lows. And then after a while, what happens? it breaks out to the downside. This has created what? A level of supply. This is what? A range created supply zone. This is a range created demand zone. And then we have another type of demand and supply zone. Remember I told you guys that there are two. We have the range created demand and supply zone. That is range created demand or supply zones. And then we also have what? The pivot demand or supply zones. Right? Now the pivot demand and supply zones are the ones that you see in a trend. Let me take you guys back to market structure. Right? If you remember, we talked about an uptrend being like this. Remember when I mentioned that an uptrend is what? An uptrend is made up of protected lows, meaning that you are anticipating that price does not go below the previous low. Since people have the knowledge that the new low will not go below the previous low, do you know what they do? They stack up orders on that previous low because they are anticipating that when price comes to that previous low, it will not break it. Instead, it's going to what? It's going to buy from it. It's going to what? Move to the upside since the previous low is protected, right? So once prices are approaching that previous low, they tend to stack up orders to buy. Do you get? Because they are anticipating that what they know that for price to continue in an uptrend, it should not take out this protected low. It will not go below the protected low. So instead, as price is coming, they buy, right? Because they know that what it will come and what puts in a new high. This is what we call a pivot demand or supply zone in the case of supply zones. Those are the ones you see in uptrends or downtrends. Why the range market creates what? A range created supply or demand zone when it breaks out. So for something like this now, this is to say that every higher low in an uptrend is a demand zone. Every higher low in an uptrend is a demand zone, right? Because the main illusion or the main understanding is that for each time the price approaches what? A higher low, it is anticipated to what? To reject from it and put in a new high. This means that every higher low in an uptrend is a demand zone. But then, don't quote me wrong, is a demand zone does not mean that it is a valid demand zone to buy from, or that it is a supply zone does not mean it is a valid supply zone to buy from. But yes, are they demand zone? That is very correct. Now, in the case of a downtrend, remember when we established that a downtrend is made up of both lower highs and lower lows. And I told you guys that the lower highs are what? They are protected. They are protected levels, right? Levels that you are anticipating that price will not go above. So in cases like this, whereby you have levels that are protected, people would want to see that, okay, since the price will not go above that point, once price is approaching that zone, they would want to sell. Do you understand? Because it's just like, let me say, the price of dollar now, that is USDT. By the time it got to 1,800, right? Per one. I mean, in comparison with the Nigerian naira, by the time that it got to 1,800 per one. And let's say it dumps now to like 1,000 per one. And then a lot of people stack up their buys. A lot of people buy like a good number, say 50K worth of USDT. And then this USDT starts pumping to what? It starts pumping to like 1,700. You see, a lot of people would want to take profits because they'll be skeptical if what people will want to sell at that 1,700. Because they'll be skeptical if it will take out this 1,800. Do you understand? Because they understand that this has been the previous high. The price may most likely not take out. Do you get it? So for every time the price is now approaching that level, they sell. They buy again. For every time the price is approaching that level, they sell. Since they understand that the highs in a downtrend, they are protected highs, meaning that the new highs will most likely not take them out. So as price is getting to that zone, they'll just sell instead. Since they know that the new highs will not take the old ones out. As price is getting to this point, they sell. since they understand that these levels are protected, meaning that the new highs will not take them out. So this is to say that with every lower high in a downtrend is a supply zone. Every higher low in an uptrend is a demand zone. Those are the type of demand and supply zones that you call the pivot demand and supply. Why the range created supply zone is when price is moving in a range and all of a sudden it breaks out to the downside. It creates a supply zone at it creates a supply zone, you see, at this level. That is called what? A range created supply zone. Or when price is moving in a range and it breaks out to the upside, it creates a level of demand that is called what? A range created demand zone. Now, if you're following this ideology, believe me, you're going to see like thousands of demand and supply zones on the chart, a whole lot of them. But here's the thing, it's not all of these supply and demand zones that are valid to buy or to sell from, right? There are a lot of them on the chart because for an uptrend now, you understand that price must keep moving in what? Higher lows and higher highs. For a downtrend, price must keep moving what? Lower highs and lower lows. So which means that every day that price moves, it is either moving up or it is moving down or it is ranging, or either way it is creating highs and lows, meaning that it is creating multiple demand and supply levels. But not all of them are valid to trade from. So we're going to quickly move into what validates a demand or supply zone. We're going to do what validates a demand or a supply zone. Now, one of the first, the first and the most important, actually, this is the most important, is the trend. The trend is the most important part when it comes to validations of a demand or supply zone. You see, the moment that you are in the right side of the market, it is very easy for you to get lucky. Trust me. You may not really be so good at picking entries and everything, but it is very easy for you to get lucky. There are people that will just like randomly go to their MT5 or Bybit, and then they will just like open trades and guess to open buy or sell. They didn't go to the chart, guess to open or buy or sell, and now the market is buying. They end up making a lot of money. Now, what I'm trying to say is that when it comes to demand or supply zones, the moment you're in an uptrend market, you will lose money. The moment you're buying, when the market is selling, you will lose money. So no matter what, at the end of the day, no matter the strategy that you trade, whether you trade SMC, ICT, Total Soup or whatever, no matter the strategy that you trade, at the end of the day, you want to be buying when the market is buying and you want to be selling when the market is selling. So whatever you're doing, your market structure is important. You have to establish that price is bullish before you start looking out for demand zones. You have to establish that price is bearish before you start looking out for supply zones. So either way, what validates a demand that you want to buy from is that price is actually bullish. Or what validates a supply that you want to sell from is that what price is actually bearish. You want to be buying in a bullish market and selling in a bearish market. All right, you want to buy when the market is buying and sell when the market is selling. Now, the second validation for our demand or supply zone is what the premium discount. The premium to discount. Now, let me explain this. Let's say you have a price leg like this from an external higher low. I mean, meaning this is not like the sub-break constructors or the minor break constructors. This is your main break constructors. From the higher low to the higher high, you're going to pick your Fibonacci tool or your Gann box, any one that you have set to 50%. Remember that when I was teaching you guys how to set up your trading view, I taught you guys how to set your Fibonacci or your gambos to 50%. Now, this is when you're going to use it. Whenever you're done mapping out market structure and there's a trend in consideration, you will map from what? From the low to the high to get what? 50%. Now, you see this first 50%, this is what we call what? The discount. In an uptrend, this is the discount. This is what? The premium. From any higher low to higher high. If I decide to map out from this one now, I take from this low to this high. This is what? This is discount. This is what? Premium. If I decide to take from this low to this high, this is what? This is discount. This is what? Premium. Now I want you to relate this discount as cheap and relate premium as what? Expensive. Do you understand? Now, since before I started this class, I told you guys that as a trader, as a person, as a market woman, as somebody that wants to do anything for anybody, your goal at every time in life may not be literally, but your goal is to what? Is to buy things at cheaper prices. And if you're the one selling, you want to sell at what? At expensive prices. Which means that for any time that you catch a demand zone in the discount of price, that is what a validation for it. Your valid demand zone must be what? In discount, which means they must be in that cheap area of price. If you should come to price level now, a leg that you're considering for a buy, and then what happens? And the demand zone is resting maybe somewhere here. It has met all of your other criteria, except that it is in the premium. This is what? This is a no-no. Your demand zones must be in the discount. For every time that you try to buy from this premium, trust me, you're going to end up with losses. Most of the times that you see people make mistakes when it comes to analysis, especially for people that trade in natural SBI, or that's the traditional thing that most people do now, right? You find out that they just look for the model anyhow that it prints without actually considering where did this come out or what trend is it on. Price can be buying, of course, but the fact that it is what's in the premium, when price tries to pull back into the discount to put in another higher low before the higher high, you find out that everything you're trying to buy here, you end up taking a loss. So imagine internally now, you're looking for what? You're looking for demand zones on this level now, internally, right? And then probably you saw one, and then price starts doing something like it's breaking out to the upside. And because he has to pull back into the discount, everything you're trying to buy here, you end up taking losses. So your second validation for a demand zone is that the demand zones must be found in the discount of price, while the supply zones must be found in the premium of price. You want to be selling at expensive prices, and you want to be buying at cheaper prices, right? And then the third one that we have as our validation is a form of inducement. Before we say that a zone is valid, there must be a form of inducement. Now let's say I want you to look at inducement, or I want you to understand inducement as deceit, deception, right? You see, in this market, people have to lose money for you to make money. As you're buying and someone else somewhere is selling, if the market is actually buying while you're buying, that person that is selling is losing money, and it is their money that you are making. Do you understand? This is to say that at every time, somebody has to lose for you to make money, right? Now, I want you to look at this inducement as we've not done liquidity and inducement, of course, but then it is one of our validations for demand and supply. When we get to liquidity and inducement properly, you understand. But I want you to understand inducement as like deception. Look at it as somebody deceiving you. It's just like somebody comes to you now and they're like, let me say, Amaka. They're like, oh, Amaka, I have this fish. I want to sell it for 500 naira. Is original. Is this? Is that? Right? They want you to want to buy it at that price. Meanwhile, let's say that the price is what actually cheaper than that. It means that what that they are actually deceiving you or inducing you to buy what at that price, to take something for what it is not, for what is not like its true worth. You understand? Inducement levels on the chart are those levels before the demand zone, right? The price rewards, the price can come to and then act like it's already buying from it. So that you feel like, oh, the market is buying, oh, let me just like hop onto it. And then you now hop on, you try to like chase the market, and what happens? It strips you out. It strips the liquidity resting on that investment level and what keeps buying. Do you understand? They're just levels on the chart meant to deceive you to either buy or sell when you're not supposed to. When we do investment and liquidity properly, we're going to look at it as like a broad topic with examples on it. But I want you to understand or to remember that at any time you're mapping out a demand or a supply level, your inducement is very, very important. This is what a non-negotiable. This is something that you can't negotiate. This is something that you can't negotiate. This is something that what you can't negotiate. Now, the fourth one is the presence of what an imbalance before your entry. Now, this imbalance can be negotiable on some situations. This is something that is very important. If you see an imbalance before your entry, it is something that makes it of higher probability. When we go on to the chart examples, I'll show you guys like chart examples of all this that I'm saying. For now, it is just practical, right? So an imbalance is just like people love to call it like price magnets. They attract price towards it. You know, in the market, we usually have buyers and sellers. And the market is a playground for equal opportunity, creates equal opportunities for buyers and sellers. So whenever it looks like there is an inefficiency whereby the market has been buying for a long while, sellers will want to sell to correct that inefficiency. It's just like when it looks like one person has been taking all the money in that job, another person will want to also like, oh, you have done your turn has passed, let me do my own turn. Do you understand? So that is how it is on the chart as well. When buyers buy for a long while, sellers will want to come and fill in that inefficiency. When we get to the chart, we look at these things properly and practically, right? The fifth one is that whatever level you're calling your demand or supply level it must break structure. There must be a break of structure. Do you understand? That is why if you look at this now, this is an example of what a pivot demand. You can see that it went above this previous high. This is what a break of structure. This is the new higher high. This is what a higher low. So at every time, whatever level you are considering as a level of demand or supply zone must break structure. So the first one is that your demand or supply levels must be in line with the trend. Your demand and supply levels must be in the discount for demand, in the premium for supply. And then your demand and supply levels must have a form of inducement below or above them, depending on whether you are buying or selling. Then there must be an imbalance or price attraction towards those levels. And there must be a break of structure. I think there's a sixth one that I'm missing out. If I should remember it, I'm going to add that as well, right? So these are like the five main theoretical like validations for your demand and supply levels. Remember that I told you guys that we have two types of demand and supply. We have the pivot demand or supply zone and the range created demand and supply zone, where I illustrated that the range created demand or supply zone is just like when price is moving in a range and then it finally breaks out. It's just like let's say BTC has been consolidating between 70K and 75K. It gets to 70K today. It pumps like 75K tomorrow. Then comes back again to 70.2. Comes to like 74.9. Comes back again to 70, back to 75, back to 70, back to 75. Until one day, it's eventually just like from that 70, it just moves straight to like 90 or 100. It means that it has broken above that 75K range. Do you understand? It has broken above that range to the upside. Now, the breakout of BTC from that range is going to create a demand zone inside the discount of that price leg, which is what we call what? A range created demand zone. The same thing, let's say, as he was doing the whole play thing between 75K and 70K, it decides to what? Now break below to like, it breaks 70K and then gets as low as 56K. You understand? You are doing me that what? That BTC has now what? Broken below that 70K range that it kept on testing and bouncing back, testing and bouncing back. So now it has created what? A range created supply zone, which must be what? In the premium. I told you that this is what? This is premium, this is discount. At every time that you map out your 50% using your Fibonacci or your Gantt box tool, this is premium and this is discount. Your demand zones must always be in the discount. Your supply zones must always be in the premium. Even if they meet all of the criteria that you have for what validates a demand or supply zone, the moment they are in the premium, it is still invalid. You understand? The sixth one, which may not necessarily be a necessity, is the sweep. Now, sweeps make what? Sweeps make your analysis. Sweeps make your analysis more probability, of higher probability, but that doesn't mean that there must always be a sweep, because there are times whereby the market can be moving in a chain of order flow that it may not necessarily sweep a low or a high. Right? When we get to the charts, like when we get to chart examples of all of this, you guys will understand all this better. This is just like theoretical statements. You understand that you would understand better on the charts one by one. So this is our introduction to demand and supply zone. Let me see if there are any hands up for questions. So if you think there's something you don't understand that I've mentioned today, you can just put your hand up. Okay, you can see 3 people now. Okay, you know what's going to happen? Since it's nothing practical, you can just drop your questions on the questions subtopic on the group. I'll definitely attend to it. Not drop your questions on the question subtopic so that this does not get so long for an intro class, right? So meeting again on Monday to now continue this properly, right? We're meeting again on Monday by 9 p.m. You can see that this particular class started by 9:05, meaning that the waiting time has been reduced from 10 minutes to 5 minutes. At exactly 9:05, every class is going to kick off as soon as possible. So for those of you that attended the call late, I want you to go over this recording again. You understand? There's nothing complicated that I've said. It may be new, but I mentioned that it's just all theory for now. From our next class, we'll start looking at these things on the charts and provide better insight, better understanding. So I'll see you guys again on Monday by 9 p.m. Before then, every question on someone said they don't understand imbalance. I didn't teach imbalance now. I just mentioned that imbalances are what price magnets and they are a part of validation for the demand and supply zones. I will show you imbalances on the charts when we go into the chart. You can notice that I was just writing. I didn't show you like price action of all these things. So when we get to the charts, you understand imbalances, you understand adjustments, you understand all of that and everything there, right? Yes, sweep of liquidity, yes.